Picture this. You just got paid, and for exactly 3.2 seconds you feel rich. Then rent hits your account. Car payment, groceries, student loans. By day 3, you're eating ramen again, wondering where the hell your money went. Sound familiar? Here's the thing. This isn't happening because you're bad with money. It's happening because you've never learned the 4 invisible rules that quietly separate people who build wealth from people who stay broke their entire lives. My name is Alex, and I spend way too much time thinking about why smart people make terrible financial decisions. If you're someone who makes decent money but somehow never seems to get ahead, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Look, I used to think rich people just had some secret knowledge the rest of us didn't have. Turns out I was right, but it's not what you think. Rule number 1, rich people think in systems, broke people think in events. Here's what most people don't realize. When you get a bonus, a tax refund, or even a raise, your brain treats it like a lottery win. You think, sweet, extra money, and immediately start planning how to spend it. Rich people, they see that same bonus and think, how do I make this money work for me forever? Let me show you the math on this. Say you get a $2,000 bonus. Broke mindset, I can finally get that new TV I wanted. Rich mindset, if I invest this at 8% annual return, it becomes $43,000 in 38 years without me adding another penny. That TV will be in a landfill in 5 years. That investment becomes life-changing money. Rule number 2, rich people buy assets that pay them, broke people buy liabilities that cost them. Now you might be thinking, Alex, I know the difference between assets and liabilities, but do you really? Because here's where it gets really interesting. Most things you think are assets are actually liabilities in disguise. Your car, liability, costs you gas, insurance, maintenance, and loses value every single day. Your house? This one hurts, but if you're living in it, it's a liability too. Property taxes, maintenance, insurance, opportunity cost. A real asset puts money in your pocket every month without you working for it. Rental properties that cash flow, dividend stocks, a business that runs without you. According to the Federal Reserve, the average American has $6,194 in savings. Want to know what the average millionaire has in actual cash? About $600,000. But here's the kicker. They didn't save their way to $600,000. They bought assets that generated the cash for them. Rule number 3, rich people optimize for time, broke people optimize for money. This is the one that frustrates me the most because I see smart people do this every single day. You'll spend 3 hours driving across town to save $50 on something. You'll spend your entire Saturday doing yard work to avoid paying someone $100. You'll spend 4 hours doing your taxes to save $200 on an accountant, but you won't spend $20 on a book that could change your entire financial future. Here's the thing, your time has a dollar value whether you realize it or not. If you make $50,000 a year, your time is roughly $24 per hour. Every hour you spend chasing small savings is an hour you're not spending learning skills that could increase your income by thousands. Rich people understand this intuitively. They pay for convenience, they invest in learning, they hire people to do things they don't enjoy or aren't good at, because they know their highest value activity is growing their income and building their wealth, not hunting for coupons. Rule number 4, rich people delay gratification strategically. Broke people either never delay it or delay it randomly. Look, everyone talks about delayed gratification like it's some magical cure-all, but here's what they don't tell you. It's not about delaying everything. It's about being strategic with what you delay. Rich people will buy a $5,000 course without blinking, but drive a 10-year-old Toyota. They'll spend $500 on a mastermind dinner but make coffee at home for 6 months. They delay gratification on things that don't generate income or valuable experiences, but they spend freely on things that either make them money or significantly improve their quality of life. Broke people do the opposite. They'll buy a $60,000 truck on a payment plan, then refuse to spend $100 on a book about investing. They delay buying assets but finance liabilities. Here's how to apply this starting today. First, audit your last 3 months of spending, not to judge yourself, but to see patterns. How much went to things that put money back in your pocket versus things that just cost you money? Second, calculate your hourly rate and start making decisions based on that number. If someone offers to save you 2 hours for $40 and your time is worth $30 an hour, take the deal every time. Third, set up automatic investing before you ever see the money. Even $100 per month invested consistently beats sporadic $1,000 investments every time. The compound interest doesn't care about your good intentions. Fourth, start thinking in terms of what will this decision look like in 5 years. That expensive car looks different when you realized you could have invested that payment and had $50,000 instead. Here's what I want you to understand. These aren't just money rules. These are life rules that happen to involve money. Because at the end of the day, being broke isn't really about the numbers in your bank account. It's about the decisions you make when no one is watching. Rich people aren't smarter than you. They just follow different rules. And now you know what those rules are. If this video helped you see money differently, hit that like button and subscribe for more content that actually moves the needle on your finances. Drop a comment and let me know which rule hit you the hardest. I read every single one. See you in the next video.